How can you protect yourself during a market correction, or even worse, during a market crash or bear market? Well, I'm going to share some fresh new visuals to help you be ready. Go nowhere. I'm DeLegge. Welcome to all. If you're here for the first time, be sure to hit that subscribe button. Now, this is part 2 of a well-received video that I did several weeks ago titled A Better Way to Protect Yourself During a Market Correction. If you missed it, I've got the link to that video posted in the comment section or description section below. Now, some of you watching this have been indoctrinated with the dogma that you should be fully invested at all times. And what they don't tell you is why they want you to be fully invested at all times, and that's because it maximizes their own income and their own fees on the money that they can charge you for those fully invested accounts. They also don't tell you that being fully invested at all times will limit your liquidity, it'll limit your safety, and it will limit your flexibility. Let's not kid ourselves. If you're fully invested at all times, just like everyone else, the only way that you can buy these wonderful assets that go on a discount during a market correction, or even worse, a bear market, is by selling your other investments to raise cash, and that would be a tragedy because you'd be selling at the worst possible time just when those prices are crashing. And so you'll notice the title of this video is a better way to protect yourself in a market downturn. And as you're about to see, I'm going to share with you a concept called the margin of safety. It's also interchangeable with safety net. And this was invented and celebrated by somebody by the name of Ben Graham. He's an investing great. He applied it to stock selection. I apply it to how you manage an entire portfolio of investments. And it is a better strategy because it's the easiest strategy for everyone to understand. And it's also easy to implement. You don't need to be a professional money manager or a financial genius to get it. If you are, that's fine. No offense. Now, what excites me most, though, about part 2 of this series are some fresh new visuals that I've been working on that I handcrafted just for you. And I did this because I really want you to understand all the requirements for protecting your wealth during a market downturn. And no matter what the current market climate is, I recommend that you bookmark this video, rewatch it, share it with everybody that you know, because I know that it's going to help you, it's going to protect you, it's going to shelter you and your family's net worth during a market downturn. Now, let's debrief you for a minute about what constitutes a well-built investment portfolio, something that's architecturally sound versus the other choice, which is something that's not optimal and not something that you'd want to own your investments in. So in the 25 plus years of my accumulated experience and research, and also studying the investing greats like John Bogle, Ben Graham, David Swensen, and the many others, what I have come to learn is that the first thing you need to understand about having an architecturally sound investment portfolio, and this is our first slide, it's similar to a building. And presumably you live in a building, or you have at least walked through a building, and underneath your feet, if you're on the first floor, is the building's foundation, right? It's what supports the entire structure. And it's the most important part of the structure. You can have the most beautiful looking building in the entire world. You can have a penthouse, a balcony, plush fixtures, but if the building foundation is cracked, if it's sinking, or if it's on a weak foundation, you are in deep, deep trouble. Now, there's a real-life example of this in San Francisco with a building called Millennium Tower. And I want you to, after this video, you can I'll help you. You won't even have to Google. I'll post a link to the Millennium Tower because it's a quite interesting story. So I'll put that in the description link below. But this building has been sinking a few inches every year. And that's big problems in any place, especially a place that's earthquake prone as San Francisco. But when it comes to your investment portfolio, what I'm trying to communicate to you is that you must build on a solid foundation, or what I call a core, that consists of index funds or index ETFs touching the core or major asset classes. That includes stocks, bonds, real estate. Those are the major asset classes. All these other asset classes like cryptocurrencies and venture capital, private equity, these are all examples of non-core asset classes. So your foundation is always the core asset classes. And after you've done that, you'll notice that you can go on to the next level, which we're comparing to the first floor, and then of course the attic. Your safety net is your first floor after you've done the core, and then your non-core is the attic. So you don't begin building a building with the attic, right? You don't start with the first floor. You begin with the foundation, and it's the same way with building your investment portfolio. Now, this discussion that we're having today is focused on your margin of safety or safety net. That part of the portfolio is what we're focusing on. So what happens to people and investment portfolios that don't have a framework? What happens to those types of investments during a market downturn when chaos begins? Well, it shouldn't shock anyone that a disorderly investment portfolio is going to lead to disorderly results. And when market chaos strikes, what happens is chaotic results are all but guaranteed. And that's what happens again when you invest without a proven, time-tested framework that compartmentalizes your money into these three sections: your core, your non-core, and your safety net. On the other hand, the prudent investor who had the forethought to build their investments with a robust framework, you'll notice what happens to their money when market chaos strikes. Well, look, nothing happens, right? Because the portfolio's consistent and durable design produces a consistent and durable return, even when all you-know-what breaks loose when market chaos ensues. And that's an important lesson. So this brings us to the next question, which is, what type of investments should you be using for your safety net? Well, these are the attributes that safety net assets should have. And this, if you look at some of these principles: liquidity, no market volatility, principal guarantees, these are all things that automatically rule out assets like gold and bonds, which are commonly mistaken as a safety net. See, to be a true safety net, the asset cannot and shall not lose market value. It should not have any volatility, daily fluctuations, and it should have principal guarantees. And neither gold nor bonds have these features. On the other hand, bank CDs, guaranteed savings accounts, guaranteed fixed annuity contracts, not variable annuities, all of these qualify as safety net types of investments. And although the returns for these types of investments will be much lower, they are serving their main and only function, which is to protect you, right? So if you want higher returns, well, you can get them elsewhere. You can get them in your core and non-core portfolio. So stop complaining about the low returns of investments in your safety net. That's not their purpose. Their purpose is not to give you high returns. Their purpose is to give you stability. And so that's a very important point. So let's talk next about your safety net. The question comes up, well, Ron, how big should my safety net be? So if I've got a $1 million portfolio, what percentage of that portfolio should be earmarked for safety? And that's a question that I get quite often, and it's something that we all wonder about. And there are really two things that come to mind that will impact the size of your safety net, and that is your life circumstances and your temperament. This will indicate the correct and optimal size of your safety net. So for example, let's just say that you have a high pain tolerance, right? You're naturally going to have a smaller safety net, whereas someone with a lower pain tolerance is going to have a larger safety net. Likewise, if you're retired, you have no earned income, you have a compressing time horizon due to your age. Nothing wrong with that, by the way. But you need a larger safety net compared to somebody that's still younger and actively in the workforce. Under temperament, we've got stomach, which deals with your ability to navigate volatility and pain tolerance, which deals with your risk capacity. Those two, by the way, are very different from stamina, because stamina deals with the question of how long can you endure the pain. And that's very different. For example, someone may have a high degree of pain tolerance, but if it's only for 10 seconds, well then it's safe to say that you don't have much stamina. So pain tolerance and stamina are very different, even though at face value they may seem very much alike. Now let's say that you've determined, and this is just an example, 30% of your portfolio is the comfortable and correct amount for your margin of safety. Now I'm not saying this is the correct amount for you. I'm just using this figure to illustrate a point. So let's just say it's 30%. So the next question is, when is the optimal time to implement that safety net? So you'll see here that there's three market conditions, right? We've got the rising market, we got a market correction, and then we got a market that is crashing, right? So a rising market environment is the most favorable climate for an investor, which makes it the most optimal choice for implementing your margin of safety. So why do we say that? Well, it's a lot better than waiting for a market correction or crashing market when prices have fallen, right? To earmark money so that you don't have to sell assets that are losing value, right? You're better off reducing exposure to those risk assets, taking some money off the table in a rising market, and earmarking it for margin of safety. That's the optimal time for implementation for your safety net. Now, the second most optimal time, which I refer to it as a semi-optimal moment, is for or is during a market correction, right? In a market correction, obviously, prices are falling. And so I like to compare the timing for implementing your margin of safety to the purchase of insurance. So if you have a home or a car, when do you buy the insurance? Well, is it before the accident or is it after? Well, your margin of safety is similar, right? You acquire it before the market takes a downturn, not after, okay? So in summary, just to bring home the point, and this is very crucial that you comprehend this, I've never ever seen anybody anywhere with an adequate cushion that has ever regretted it, especially when financial markets are tumbling. But I have seen lots of people without an adequate margin of safety that have fully regretted that decision by not having a cushion. So if your investments are getting clobbered, or if you're fearful to the point that it's causing you anxiety, well, I'm here to tell you that you should not stay the course. You must identify and fix what's wrong. And based upon the portfolios that I've analyzed, portfolios that have problems, it's often because of the fact that there's a failure of having a cushion or an adequate cushion. So getting back to your safety net, and these are some key takeaways from today's conversation. All investors should have an adequate margin of safety. And as we learn, the size of that depends on your temperament and your life circumstances. Rising markets are the best time for installing and implementing your portfolio's margin of safety. So I've given you some very helpful tools, and I know that these are things that are going to help you big time, preparing you for a market correction or bear market, whatever comes next. I also, by the way, have for those of us that want to get a little bit more granular, I have a margin of safety worksheet. If you want to calculate the precise percentage or dollar figure, you can download this in my class titled Build, Grow, and Protect Your Money, a step-by-step guide. When you enroll in that class, you'll get a margin of safety worksheet, and you can use that worksheet, put in your numbers, put in your specific age and some other details, and that will help you. That will give you some very good guidelines as far as what you can do or how much you should earmark for your portfolio's margin of safety. So I hope you've enjoyed today's episode. I've shared some fresh visuals. Let me know what you think. If it's your first time here, be sure to subscribe to ETFguide TV. And if you'd like to have your portfolio analyzed and graded, you can reach out to me at portfolioreportcard.com. Be sure to check out the other fine programs on this channel like ETF Battles. And again, don't forget to subscribe. I'm Ron DeLegge. We'll see you next time. Thanks for watching.